Now we're going to turn to the international market and how the U.S. plays into that, obviously. But one of the things that we always like to remind you, please like, share, subscribe. We always appreciate your support. So now when we look at the U.S., we had that drop down in gasoline of 122,000 barrels a day. We expected to see that drop, and we as we were saying, it was expected to be just below what normally is because Mexico, Brazil, we continue to see some of those flow throughs. It's just going to be that timing of when do we see that released, when do we see U.S. Some of the headwinds into U.S. exports. Distillate had that increase of 174,000 barrels a day. It was just 35,000 below the 5-year average. That's where we think at this point you'll see a little bit of that flip. Gasoline will stay fairly strong. Distillate will pare back a bit. Propane was up 577,000 barrels a day. Again, timing, but the surge is there. The demand is there. We're going to continue to see, if we had to average it out, you're going to be well over 1 million barrels a day of propylene going into the international market. Now, when we look at crude exports, as we were saying previous weeks, spreads have come under pressure, but they were open before, and that's where you're starting to see some of that residual come through. So here we actually had a big increase of 953,000 barrels a day, almost 1 million barrels a day increase in U.S. exports, coming in at about 3.884 million barrels a day from the previous 2.9. Now, we were expecting to see a little bit of a decrease and then a big increase because typically the way these exports have been moving, they've been very much weighted towards the end of the year. The end of the month and not so much in the middle of the month. And that's where we're getting kind of that big shift where we actually had a big increase in the middle of the month, and it's multi-faceted in terms of why. And the question is, when you look at condensate demand, we've seen that increase, and now we're starting to see some big headwinds in terms of naphtha cracks in Europe, and that's because European refiners are ramping back up, and they've imported some of this naphtha. So now you're in this kind of glutted market in temporarily, not saying that it's going to stay like that, but a temporary glut within that market. You see the spreads coming under pressure. That again is going to kind of slow down some of that capacity, but we still have that steady bit of about a baseline of, let's call it 1.8. And then we'll get that delta. Now, the Asian side is slowing down just because the spreads don't make sense to go into Asia. Some spreads, depending on day, still make sense going into Europe. So we're still going to see some of that support. U.S. to European flows are at 14-month highs because they need that light sweet. As they start to kind of catch back up, we're going to see some of that slow down. Still remain elevated, but what we lost from Asia, some of that will get picked up into Europe. But it's still going to, again, get closer to our average of that 2.6, 2.8, probably closer to the 2.8 side versus the 2.6. Even though we should have some of that pressure on spreads, it's going to take a little bit of time for that to show up, and we think that's more of an end of June situation. Now, China saw that gasoline demand recovery. Demand in May was seen at about 3.5 million barrels a day versus the 2019 of 3.4. But we also saw a big increase of exports. So it's kind of this back and forth, and we'll talk about that more in a minute, especially when we look at India. Now, drive-in activities have recovered to 85% of pre-pandemic levels from 55% in May after easing of restrictions across several Indian states. So that's the other thing we're starting to see. But when we look at some of the variants, the lack of vaccinations, that's where we think that you're going to kind of hit this plateau, especially when you look at some of the Asian markets. But again, those are net pulls. Now, the reason why we talk about that, and then we look at WTI Dubai spread, here's where you can see that big drop off, and it's why we're going to continue to see Middle East crude take some of that market share. And as you see this readjustment of what kind of crude is being pulled in, what kind of crude is demanded, that's where that Asian side is just, they're not going to come to the U.S. at this point. They'll go to the Middle East, they'll go to West Africa, they'll go to Russia on the ESPO Ural side. And that's going to, again, cap some of our flow into Asia. Some of it instead will go to Europe, and then the rest of it will get caught on the coast. And this is when we now just looking at the products in general. So you had that big drop, that big spike. Then we were saying that you're going to get a pullback. We thought it was going to be closer to the top of the cloud. Instead, it still remained elevated. The pull in from Brazil and Mexico remains fairly strong. And again, that's pulling down some of those exports. And the PADD 3 is also trying to balance out their gasoline storage because we're continuing to see some of these gasoline builds. Yeah, and it's really demand versus exports, trying to balance that while also creating the different spreads. Because when we look at what is being created, gasoline production was down 1.3%, and distillate production was up about 0.05%. So you're still seeing these refiners trying to kind of balance their approach. And as PADD 2 remains elevated and PADD 3 remains elevated on that refinery throughput, they're just going to have to, again, manage that, especially on the PADD 3 side, in terms of managing some of that production, because gasoline production is 245,000 barrels a day above normal, above the 5-year average, 607,000 above the year over year. And distillate remains production at fairly balanced. So you have that excess capacity on the disty side that you don't have on the gasoline side, which again speaks to more imports into PADD 3, trying to increase runs of a heavier cut, allowing for more middle and lower stack to see additional operation. And then when we look at the distillate side, even on a seasonal level, you kind of have that steady trend up. We were expecting to come down a little bit and then kind of get that seasonal spike. Instead, the spike came a little bit earlier, which just means that you'll get a pullback. It's just going to be a pullback closer to the previous 2021 high that we saw in May, just not a huge retracement because we do have some of that bullish backdrop into Latin American region. It's just going to be a question of how much of it is being filled by Asia, how much of it can be filled by the U.S. in general. So then when we look at exports, here you can see that break to all-time high, back to seasonally adjusted highs just off of the 2021 high. We were expecting this to be a bit more sideways, where we were saying it's going to be in the top of the cloud. You're going to see this here. This just means that we'll drop back down, but again, closer to this pivot point of about 2.8 and down into that level. It'll be a matter of timing. When does that come through? It's just because of that spread headwinds. Those are the things that we think we're going to continue to see a bit more overhang, which again is going to cap some of our exports in general. And when we look at just the 4-week rolling average, the 4-week rolling average, we're sitting here at about 3.2 million barrels a day. And that's where we think that this will trend down over the next few weeks, getting closer to what we've been talking about with that 2.8. Then when we look at propane breaking out back to those highs, again, it's going to be lumpy. It'll just average well above the 5-year average, much closer to the top of the cloud, probably setting new, when we look back on the season, it'll probably set new 2020, high records in terms of exports, just given where the global market sits. Then when we look at crude in Europe, we had a nice draw, which we were expecting to see that it trending closer with the 5-year average. Instead, we had a nice draw of about 3 million, bringing us to the lows, and that counter seasonal draw, which is spoken to based on refiners are ramping up, pulling down more crude. We're still seeing those delays in terms of onshore. Taking offshore crude, onshoring it. These are things that'll take time. And it's just because we have refiners ramping up, we're just going to see this remain well below that 7-year average. And it'll go sideways, but again, it'll still be a net positive for where we sit in Europe at this point. Now, when we look at just the loading market and the physical market, there's a lot of bifurcations in terms of spreads. And it's one of the things that we'll talk about in more detail as we go through, but just to provide a summary here. So when we look at June and May, you can see that there's been a little bit of a shift, and it's been recognized in Angola. So Angola had product move out of May. You had a big increase in June because they're trying to now push the deferred cargoes that were there. They're trying to push them out in June, recognize some of them in July, even though they still have six cargoes to sell in June, and they're still seeing a lot of these headwinds as we go into July, with August set to be released this week. Now, when we look at Nigeria, something similar. Norway's elevated, but now Russia is seeing a very steady increase in terms of loadings. And it's a mixture of two different points. One, you have a little bit of an elevated downtime on the refining side, but you're also seeing them trying to capture more and more of this market. ESPO spreads have still remained fairly strong. Urals have gotten a little bit better, and that's Russia trying out and trying to capture more of that market. Libya came down a bit. We expect that to increase back above 1 million as we go into July. Then when we look at some of the spreads going forward, because remember, when we look at the UK, you had that drop off, and now you're going to get that spike back up after that pipeline work is complete, which should be in the next few days. And we're starting to see some of that softness. Not huge softness, but 10 cents off of what it was. Now, on the other side, when we look at Angola, cut its oil forecast for the year due to the declining production of maturing fields, which we continue to talk about. So July loadings in Nigeria, some of them are now offered at $1.30 above dated Brent, an increase of $1. Now, that's where the seller is offering it, and that's the skew that we're seeing right now. Is sellers are like, all right, well, let's test the market, let's see how hot this market is, and it's going to be important to see when does the buyer step in. Is it $1.30, $1.20? Is it something? And now this is Scravo, so it's a good blend in terms of where things sit. But this is going to be that pushback in terms of, okay, well, spreads have gotten much stronger, so clearly the physical market is stronger, so let's test it out. Now, the offer price for Nigerian crude, again, seeing that gaining. There are fewer new cargoes for July loadings due to the delays involving multiple Nigerian cargoes. So July is where they're trying to kind of make a stand and sell down that excess at this point to try to get some of that going through. 10 cargoes for Angola. 6 cargoes are still there for Angola to sell in July, which is, again, much slower. Half of Nigeria cargoes are still unsold. And that's why they're trying to make that stand and again, get rid of some of those deferrals so then they can focus a bit differently. Now, the things that we're still waiting for is the demand from China in terms of where some of those flows will be. That's what we're still waiting for. Russian ESPO crude for late July, August loading came in at $3.50 a barrel to the Dubai benchmark. Again, that's the highest premium that in almost a year, which ESPO has been strong, and that remains the case. That's why we're still waiting to see some of that push through. So if you're West Africa, they're sitting there saying, okay, well, Dubai's stronger. ESPO is trading at a premium. Urals went from a discount of $1.85 to $2 to $1.65 to $1.15 discount. So let me see what I can get on the West African side, and that's where we're seeing some of these spreads kind of feel each other out. Now, on the Glencore, Urals sold for $1.65 less dated Brent, which was below where it had traded previously of $1.15. But then there was another trade that happened. It was at $2, came across at $1.15. And then when we look at Glencore, Urals to Shell, came in at $1.65, discount to Brent after being $1.95 on June 8th. So you're starting to see some of these movements in general. Then when we look at some of the movements on dated Brent, so Urals are set now at July 7th to 11th delivery at $1.40 below dated Brent, was previously $1.65, again, trying to test those waters. Vital, when we start looking at dated Brent going through essentially end of June into the middle of July, things are set at about a negative 15 cents to dated Brent to a negative 10 cents, trying to figure out, again, feel out where that is, which is a positive. It's just, where is this actually going to cross? And that's going to be that big question mark, because if you were to look at spreads, you would assume them to cross at this level, and that's going to be a big tell kind of how things are going to look as we go into, really the August and then into September. Now, one of the things that keeps coming back up is really where is that OPEC plus spare capacity? As we come into April, this is where we sit. We did have an additional, let's call it about 850,000 barrels come on. So you're going to see some of that draw down. And this is why we talk about where things sit on days of supply, where the US is, where the OECD is in comparison to others, because we still have that excess capacity. And the hope is that by the time we get to July, you're going to have drawn down let's call it 3 million barrels a day of that spare capacity. You're going to be in that comfort point, and you'll be able to support the current pricing. Again, trying to project forward, which is what the futures market is doing. It's just, if things were going to be so tight in the future, you would think things would be in a bit more of a contango situation. Because when we were trading crude back when we were at 100 on our way to 150, we were buying crude at 115 and storing it to sell it at 140. So it's just going to be a matter of where does the market kind of feel itself out. And this is something Tanker Trackers had an interesting data point, and it's looking at Iran. So they were saying that Iranian exports, as they see it, came down in May. And the reason why is because their own fleet is currently storing 70 million barrels of gas condensate due to insufficient demand from China. And that's where it's not so much that Iranian oil is going to be a bigger overhang, because given there'll still be an overhang, there's still oil to get absorbed into the market, but it's the condensate side, because they have a lot of condensate and heavy naphtha that they can push into the market, which the pie for liquids has gotten bigger. So will this impact U.S. pricing? Yes, but only to a point, because there's still going to be that adoption rate, and there's still a growth of plastics. There's still a lot of petchem coming on. So that's that balancing act. But we did see some of that Iranian crude come out of the market. We're going to see some of this kind of move back through. But these are things that are going to be important, because when you look at ESPO, you look at some of the spreads, when you have Iranian crude falling, that's going to tighten some of that Asian market, because that's where a lot of these barrels are really ending up. Now, they're projecting the hardliner is going to win. The question is going to be what happens after that point, with the final election being on the 18th. And that's going to be that pivot of, well, how much do we give back? How willing will we be to enter back into the nuclear deal? And Iran is going to be incentivized, because again, they continue to struggle with those economic situations. Now, rounding out, when you look at the U.S., so this is just looking at where things, had that peak for propensity to emerge and spend. Now, they had adjusted this where you can see the start of that piece was at about March 28th. And so from essentially March 28th to April 29th, you had this peak search activity for where am I going? Where's my vacation? And there's two ways to look at that. The bearish side is, oh, well, people are not looking for deals anymore. And the bullish side is, well, who doesn't prepare their vacation? So clearly you're going to prepare your vacation. You're going to try to take advantage of these deals, and you're not going to have to search again. So there's two sides to that, which is why it's always important to look at that weighted average of multiple data sets. What this is also telling me in terms of some of the different capacity is consumer spending. Because how is consumer spending changing? We're seeing that drop in retail sales in consumer goods, but that increase in experiences, that's services. And that's where you're going to get kind of this shift to, okay, well, durable goods, now we know they're going to stay expensive. We can see that in terms of inflation, delays in the supply chain, but you're going to have people doing more on the experiences side, which is going to drive those inflation prices higher, inflation and that level higher. So that's going to kind of be that swapping capacity. And then when we look at China, so China's reporting a higher refining capacity, 14.31 million barrels a day in May. And it's important to appreciate that. The reason why that's the case is because part of the investigation that the CCP carried out was that the teapots were underreporting throughput. So this is now forcing them to either recognize the throughput or penalizing them and cutting their import quotas, which is allowing other refiners to gain a little bit better margin and seeing them operate at a higher rate. It's also important to appreciate that they've had new refiners come online in 2020 in the beginning of 2021. So they should be going higher. This is not a something that it's like, oh my God, everything's back to normal. It's they have new assets coming on that will account for this increase. The question is going to be, where does the product end up? Which is why when we look at China's May apparent oil demand, actually was down almost 1%. So you could say, okay, well, how does that make sense? Because you had the refinery throughput was up, but apparent demand was down, and that comes down, and it's an imperfect calculation. You know, it's hard to trust Chinese data. So there's always a calculation, and there can always be some error within that calc, because the million barrels per day that was apparently demanded was 13.58 million, which goes against kind of that 14.1. And that could be because of additional imports of refined products. That could be from additional exports of refined products. That is adjusting some of what the actual oil demand was internally versus what they actually ran. So this is why, again, looking at that push and that pushback in terms of those different pieces. But this is where we still see crude refined product demand still below normal, even though gasoline is kind of at that consistent level. It's the diesel side. It's some of these other components on the economic manufacturing that it remains the overhang. That we've seen several brownouts. We'll talk about that in segment 1 of the Econ Show. Some of these Chinese overhangs are going to remain in the system, again, kind of capping some of that growth. So then when we look at India total petroleum product consumption so far through June, we've had recovery since May. May was kind of that peak downturn. You know, things are getting better. States are opening back up. It's always important to look at, again, that year over year and versus 2019. So it's still down versus 2020. Diesel's down 7.5%. Gasoline's down 3.5%. And then against a quote unquote normal year, you know, diesel's still down 21% versus 2019 and gasoline down 20.7% versus 2019. We still expect gasoline to recover a little bit faster because diesel is going to be a bigger overhang. The underlying issue is the cost, because diesel prices in India have hit a new record. And even though people will try to get back to normal, inflation is now well above the central bank's target. They're running hot. They're going to have to say, you know, one of the things that we talked about back in March and April was the inability for India to cut the gasoline tax or petrol tax that they had put in place in 2020, because they had to gain some revenue, because they're running right now the steepest deficit they've ever run on a fiscal level, even with the increase in taxes factored in. So to cut those taxes is just going to make their fiscal deficit even worse, and again is going to impact some of that financial support that a lot of these countries still need on the back end of COVID, especially coming out of a lockdown. Then when we look at Fujara's at 11-week high. Total stocks were at 23.47 million, which was an increase of 1.135 million, up 5.1% week on week, which essentially pretty much offsets the draw of 1.359 million the previous week. So again, we're kind of in that steady state, which is what we were talking about last week, where we expected that big increase in light distillates and started to see some of those drawdowns in heavy disti. But let's go through this in pieces. So stock of light distillate, including gasoline and naphtha, rose 2.137 million barrels, up 42.9% week on week, to stand at over 7 million. So this is a big reversal that we had seen, and it stands at the highest level since March 29th. And market participants are saying that the rise was due to delays in loadings at the Fujairah ports, where suppliers, including Saudi Aramco, store their products, which again is impacting some of these movements. And you're seeing the Asian gasoline demand remained under pressure on a lower U.S. RBOB Brent crack, which has really been dragging down some of these Asian crack spreads. And just given where the expectations are in the U.S., where we continue to see these builds, we're getting stuck because you have additional product getting exported out of Asia. some of it's getting sold into the market and the rest of it is getting stored. And that's becoming kind of this overhang that we're seeing as you kind of come through from Asia into the U.S. market, I should say the Atlantic Basin. And then middle distillate, jet and diesel had increased by 509,000 barrels total to almost 4 million, which was up 14.6% week on week. And the gas oil market, is seeing some of these support from a mixture of things. So you have the cuts of Chinese gas oil exports, which are expected because of the adjustments that they're making at the teapots, the levies. But then at the same time, you're not seeing a whole lot of demand for gas oil in the Middle Eastern market and in the and you have a decent amount coming out of Asia getting stored in other places. And now some of that will go into power gen, but for the most part, it's the heavy resids that are going into fuel power consumption. So those fell by 1.5 million barrels, which represented a 10.9% drop. And that's mostly because of regional demand for fuel oil because of summer cooling and that electrical generation. So that's where some middle distillate also gets pulled into that. But the gasoline market is the one that remains soft. And now, as we said last week, 2 refiners were down because of some trips. Those have now corrected themselves. That'll push more product into the market. And again, that's going to keep things elevated within Fujairah. Now, when we look at crude oil in the water, we had that step away from that 5-year average. We typically get a decline. It's obviously the rate of change is much lower. If this is driven by 2 different things. One, there's less crude in transit, and there's also less crude now that is being stored. So this is where you're seeing that total number move down. And that's why when we look at crude oil in transit, here's that big drop. That will reverse because when you look at the 5-year average, we typically come down this much. And then you start to see that increase as we go through the end of June. And that's where we expect to see some of that pick up over the next few weeks. Where here, when we look at floating oil storage, it's just flatlined. Just because we're getting some of this crude that was in transit, getting there, parking, some of the crude oil floating storage getting pulled on shore, being replaced. And here you can see that we're right back to where we were in 2016, which was still a very elevated level, but again, a bit more normal versus obviously where we were in 2020. So then we won't go through this too much because this hasn't updated since the Frac spread show. This updates tomorrow. So here, I should say since the last EIA show because we filmed it on Thursday, so we were able to capture this. Here we had a fairly steady draw across those products, especially gasoline and gas oil. Here's where you see that drop in gas oil. We've actually seen some additional exports into the European markets for gas oil from both Asia and the U.S., which will continue. Gasoline, still some steady draws, but not where they should be given where local demand is and where their exports are. So that's going to be the biggest one to watch for tomorrow. And here's the fuel oil side where we're seeing some of that additional recracking, trying to, again, increase that gasoline side, which is why those draws really haven't been to where they should be. And then the same can be said about Singapore. We expect to see a steady increase in storage. And not to say it's going to be a huge increase, but really kind of holding this line at the very top level as we continue to see middle distillate and light distillate, trend higher with some of that resid getting pulled back down. And here's where, when we look at the middle distillate, you're coming back to that 15-year average, which is where we think we'll see some of that steady increase. And then here you had that big spike off that 15-year average in gasoline or light distillate coming back down. Now the drop in Asian demand for light distillate is going to show up here and some of that oversupply. So that's why we expect to see a bigger increase in that light disty. Now the Brent time spreads. So just looking at August versus September, just exploding higher. We're at the highest it's been since. Going back to February, we took out those highs. Again, this is what some of the physical market is looking at. Is like, okay, well, why are the spreads doing that and my product moving the way it is? Well, maybe that's because the market is better than we perceive. So let's start putting some of these offers out there at a much higher level. And that's where you're starting to see some of the pressure where Brent, December versus December, WTI and Brent both, again, driving higher. a lot of these spreads continue to get bid, but it's putting pressure on refiners, where now refiners are turning further negative again. And you're seeing pressure in the US as well as Singapore, which again is going to become this catch-22 of, well, if refiners are the largest demand of oil and you're seeing builds in products and you're seeing increases in crude prices and some of the pressure on pricing, especially in Asia, well, that's going to depress some of the activity and not incentivize them to increase run rates, which we continue to see as an overhang, specifically in the Singapore Asian markets. And here's where you look at over the last, and remember back in Feb, when you had spread spike, you also had refinery margins going up because you had this an increase in demand, and now we're not seeing that same type of residual impact in product demand in Asia right now. There's spits and starts of it, but again, there's still those overhangs with COVID, some of the additional lockdowns, and just not seeing the same type of activity as inflation continues to bite harder those individuals because of the emerging market side. Then when we look at Urals, starting to see, again, some of that pressure coming down, but just based on where things are, they're still net positive. It's just it's getting a little bit tighter, and we expect to see more Libyan barrels working their way through. And here's where we continue to see kind of this bifurcation, which is we're actually seeing this pulled further negative. And that's where I think our Urals are going to start to get pushed out a bit. We're going to see more Libyan barrels get pulled through. Again, this is kind of that push and pull that we're seeing specifically within the European markets. Now, China super tankers, this is something that we think is going to start to creep a little bit higher, especially as they feel out where things sit, where is the backdrop between runs, who has the import quotas, who doesn't. These are going to be things to watch over time. Run rates, again, the teapots were forced to recognize their actual rates, and if they didn't, that they were forced to decrease, which allowed others to ramp up. So they're currently at about 72%, which is a nice bounce off the bottom, but we continue to see them remain at a very elevated level of just crude and storage. Asian floating storage still remains at really all-time highs versus a lot of these different levels. When you look at kind of where things sit, it's getting a little bit tighter. But again, because of the issues we're seeing in the Middle East into Asia, Russia into Asia, we continue to see these floating storage remain elevated, especially when you look at the bottlenecks in the Chinese ports, which again we'll talk about in the Econ show tomorrow. North Sea had a drop, more along the obviously accelerated, but when you average it out across the 5-year, we think that this will again bounce back up and be fairly back and forth over that time period. Where West Africa back to those highs again, they're trying to push those additional cargoes out. There's still cargoes left to sell. This is something that is going to remain elevated, and even though they're trying to put a better differential on it, it doesn't mean it's going to cross. And then when we look at the Middle East, you can see that we're still elevated above 2020, below where we were 2017, 2016 when we had the OPEC war, pricing war. But that's where they're pricing to move. And as WTI gets more expensive versus Dubai, this will help incentivize move some of these cargoes out of storage, which is why we think that the oil in transit is going to increase over the next few weeks as some of this moves from West Africa. You start to see some of those sales, and you'll start to see some of those movements into the global backdrop. Europe, something similar. With this is going to trend back up. It'll come down to when does the pipeline finish? When does that start to load back up? But again, it's going to be at an upward trend, not a huge spike, but again, back to a bit more of a normal backdrop. And here's where we look at crude in Shandong, continuing to remain at 2021 highs, seasonally adjusted all-time highs, because they have that steady flow of oil. Now the problem will be what happens if there's a big hit. About 50 of these individual refiners are under investigation. Some of them have already seen sanctions. And again, that will weigh on some of that demand, which will keep the crude stocks elevated. And here's fuel oil starting to come down. We're seeing a big increase in exports. And those export quotas are expected to go back to increase. So that's where we think some of this fuel oil will get pushed more into the market, speaking to, again, those elevated storage levels in Singapore and Fujairah being driven by some of these shifts. So I know we covered a lot. We try to round it out in this segment. So if you have any questions, please let us know. We always enjoy the back and forth. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.